Welcome to the Can You Do Any Better Investing channel, part of the Can You Do Any Better network. First off, I'm not an investment advisor, and this is not investment advice. I know that we all have YouTubers that we like and we trust. Please don't just blindly follow what I do or what anybody else does on YouTube. We are here to learn together, so please, everybody, do your own due diligence and hone your own investing skills. With that said, let's go to the video. Today's video is going to be on ticker FOMO, FOMO. Of course, that's not an actual stock ticker. It's an acronym and it's short for fear of missing out. And it's an incredibly important investing term. I want to talk about it today, and I want to talk about responsible investing. Investing can be fun. Investing can make you money. However, investing can also be a nightmare if you are not careful. I want to take you through a chart of a company called Sensonics. This has been a very popular stock to trade for retail investors. On the first chart here, you're going to see this stock was an 80-cent stock from January 14th to January 20th. So in 1 week, almost 314%. So over 300% increase in this stock in 1 week. A lot of people made a lot of money on that. But I want to show you another chart. So from February 17th to March 5th, this stock then proceeded to go down 65%. So that's just a couple of weeks. That's under 3 weeks of time, and that's a 65% loss. That's what the fear of missing out can do. The problem is a lot of these popular stocks can have a wild run up, but they are oftentimes followed by a crash. Too many of us retail investors end up on the short end of the stick on these and end up losing enough of our money to discourage us from investing, and we get out of the game. And that's not what we want. We got to be in investing for the long haul. I know we all want to make money, and quick double ups and triple ups are great. And if you scroll through YouTube, you'll see 2x, 5x, 10x, 100x. Some of my videos even have that on them. But you got to remember time frame. A 2x or a 5x or a 10x, that could be a year or 3 years or 5 years. A lot of people see that and they're expecting this thing's going to double this week or this month. And that is reinforced by the fact that a lot of these retail stocks actually have done that. The problem is, even when they do that, oftentimes the investor ends up losing most of their money. So first, set a realistic goal. So before you go to invest, and many of you may already be investing, so you can take a time out tonight, whenever you want, and kind of press a reset button if you need to. And it never hurts to revisit your goals anyway. So step one, set a realistic goal. A realistic goal is not, I'm going to triple my money this week. A realistic financial goal is, I have this much money I can afford to invest. I'm going to invest it. I have this much. My tolerance for risk and for loss, you need to understand. So, are you okay losing 10% of the money you invest? Or are you okay losing 50% of the money you invest? What happens if you lose all the money you invest? So understand the answer to those kinds of questions. And that goes with the next step. Create a strategy. Once you've answered those kind of questions, you can create an investing strategy. There's 1,000 different ways to invest. So I don't day trade. Your broker won't even let you day trade unless you meet certain thresholds of dollar amounts in your account and experience. So day trading is literally buying and selling a stock inside of a day. So it's high levels of activity, and it's high levels of risk. Hopefully none of you are day trading, and if you are, good luck. Then this is probably the wrong video for you. The two types of trading strategies that I like to look at are swing trades and long-term investing. So swing trading is basically buying and holding for some short to medium period of time. The other strategy is more of a buy and hold. So that's a long-term strategy. So, holding a stock for a year, 2 years, 5 years, some stocks you may hold for a lifetime. There's plenty of examples of that. Those are usually blue chip stocks. Next, know the companies you invest in. A wise man once said,
This is not financial advice. I just hope you brought your oven mitts, baby, because it's about to get hot in the kitchen. And don't invest in the companies that you don't understand and don't believe in, because if they dip, you not gonna buy the dip, and then you gonna sell low and be right back here crying to me.
Thanks, Keenan. Good advice. Anyway, his point is 100% correct. Know the companies you invest in. So before you go buying a stock, you got to research the company. You should know what you're buying. Know what the company does. Know its profitability. Know its short-term goals, long-term goals. The more you know about a company, the less chance you're going to have of selling off at the wrong time. And not all dips are for selling. So know your investment. Next, review your strategy regularly based on updated information. So this is not a stagnant world. Things are happening every single day. The same thing is true for the companies that you invest in. You may have gotten to know your company, you have a goal, you created a strategy, you got to know your company, then something happens, the world changes. And that could be in many different ways. I'm going to give you a quick example. I went through a company just a few weeks ago, a company that I like, and I'll tell you, I think it's stock ticker RMO, Romeo. They make fuel cell packs. It's a company that I've had my eye on for a long time, and I like them. They had to inform their investors that they don't have any fuel cells, which is the key component to a battery pack. They had to reduce their forecasted sales by over 80% for the year 2021. Keep yourself updated. Information like that is important. Doesn't even mean you're going to sell the stock, but you certainly ought to know when major things happen like that. So as a general rule, I personally like to stay under 10 companies that I'm invested in, but that's a part of creating your strategy. So everybody's different. Know yourself, know how many companies you're comfortable following and staying up to date on. Next item, don't chase. You'll see stocks go on big runs. Once it's in the middle of a run, that's when FOMO starts to occur. You're seeing a stock go up and go up and go up, and at some point, you jump in because you just can't take it anymore. You're thinking everybody else is making money on this stock. I need to get in. Well, that's not really an investment strategy. That's just chasing a stock and chasing money. So you haven't picked an entry point. You have no idea what your exit point is. You may not properly know the company as an investor. So chasing is one of the big things that causes people to lose money. As it pertains to swing trading, a couple of rules. One we kind of just touched on. Be careful of momentum trades. So a momentum trade is one of those trades where it's going up, it's got a lot of momentum, everybody likes it, all you hear are good things about it, everybody you meet says that you should buy it. That's a momentum trade. So if you're gonna get into that, I would recommend using a stop loss so that when you get in, determine the amount that you're comfortable losing and put a stop loss on. You don't know where you've gotten in on the momentum train. If it's at or near the end, you need a stop loss. The giant run up is oftentimes followed by a giant crash. So you do not want to get caught on the wrong side of a momentum trade. Use a stop loss. That is a good tool to mitigate your losses. Next, buy low, sell high. Sounds obvious, but this is critical. If you're looking at a chart and that chart shows that the stock is on a big run, then you're not buying low. It might go higher, but again, you're getting involved in a momentum trade. So you've got to be very careful. Buy low. If something seems like it's at a recent high or an all-time high, it is most likely probably not a good risk-reward equation to start buying into that stock. If you've done your due diligence and you see a stock trading low, way off of its either recent highs or all-time highs, that is how you buy low. Doesn't have to be its absolute all-time low of all time. It should not be at a high, and you should have done your due diligence first and know the stock. Then lastly, don't throw good money after bad. Oftentimes what happens is when you get in late on a momentum trade, you put a bunch of money in, and all of a sudden there's a big dip, and you tell yourself, all right, I'm going to buy on the dip. So what you don't realize is that's not really a dip. It's the beginning of a long road down. So you buy the first dip, it takes another leg down. You say, okay, let me double down again. I'm really averaging in here. You know, you're using some of these concepts. Okay, I'll average in over time. So you put more money in. Now the problem is you bought high, you're buying on the way down, and at some point, you know, we looked at those charts where in a month or 2 months, sometimes even 3 weeks, can be a very long time if you're losing money every single day. So that is how you get driven out of a stock. You've got caught up in a momentum trade and you start throwing good money after bad using the thought process that, well, I'm averaging my basis down. So use a stop loss like we talked about and just get out. So this is how people lose all their money. However long you think you can hold out, after a month or 2 months, you're going to sell at what turns out to be at or near the low, and it really doesn't matter. What it's going to be is it's going to be a lot lower than your cost basis. So this is my little list of obvious tips, really, on how to avoid FOMO. I like to look at this list myself and remind myself, because no matter how much we all already probably know everything that I just talked about, unless we remind ourselves of it on a regular basis, it is so easy to get caught up in the excitement of some of these stocks and some of these investment opportunities and some of these emerging industries and emerging sectors. So please be careful, invest responsibly, watch out for FOMO, and let's be in this for the long run. So thanks for watching. Like the video, subscribe to the channel. We've got lots more content coming. Please invest responsibly. Comment below. Do me and all the viewers a favor, and I'll try to respond to comments as you guys write them. So again, hit the like button, subscribe, hit the bell if you want to be informed when our next video comes out, and good luck trading.